Right, welcome all of you. Today we'll discuss value-added tax. What is the basic concept of value-added tax? I'm going to discuss today. So first of all, what is the business process life cycle. So what is that? So it is input and process, and the finally you will get output. So which is called business process, right? Business life cycle. So whatever the things you input over here, and then there may be process, and then finally you will get the output. So what are the things you will include as input? So here you will input raw material. So input raw material. Then raw material, anyway, you have to purchase from others, right? So raw material you have to purchase. So there may be two type of purchases, right? Local purchases, right? Within the Sri Lanka you will purchase, right? So and also you will have imports, right? If you are unable to find out whatever the materials, then anyway you have to import, right? Then we call these things whatever the things you are putting into the raw material and putting it into as input, right? Then this will become your input tax, because when you are purchasing, let's assume you are purchasing this item, you incur 100 million, then you paid, as let's assume you paid VAT as 15, then the total value is 150, right? This amount you paid as value added tax when you are purchasing, right? And you put those things as input, and then you did some value addition over here, right? You did some value addition over here, because anyway, whatever the things you purchase under raw material, you can't use as it is, you can't save. So you will do some value addition. Let's say you did some value addition, including the profit margin and all, let's say 100, right? Then your output would be your what type of item? Your sales, right? Your output would be your sales. So here you will put input over there and process, and finally you will end up with finished good. Then the definitely finished good you will sell, right? When you are selling, maybe local sale or export, right? Different tax rates are there anyway. Let's assume in local sale, right? You purchase 100 million worth of raw material, and those are input into the process, and you did some value addition including profit margin, then your selling price would be, then the 100 plus value addition, altogether your selling price would be 200. Then the VAT component is, let's say VAT is 15%, then your VAT would be 30, right? So what you can do over here is, whatever the VAT you paid, you can take as deduction, right? Take as deduction. Then the input VAT, whatever the things you paid as VAT when you are purchasing, right? You can take as input tax credit. Input tax you paid. Then you can deduct this 15 out of your sales. Then there is a balance payable is how much? 15. Actually, this 15 on what? Actually, this 15 is the on the value addition. This 15 is only on value addition, right? So that's what called value added tax. Then you have to pay VAT on value addition. So whatever the things you purchase, you can take as credit. So then you are paying VAT on value addition is 15. VAT on value addition. This is the basic concept, right? On value added tax, because value added tax. Then you are actually paying VAT on which amount. Actually, whatever the things you did as value addition, this 100 multiplied by 15, you will get the same answer, right? But anyway, the calculation process is this, right? You can't directly take the value addition and pay VAT. The process is this. How to calculate VAT payable? Formula is VAT payable equal output. Output tax. Output tax is 30, right? Minus input tax. How much input tax? 15. This amount, right? Then VAT payable would be after resolving this formula, you will get 15 is value added tax payable, right? Hope this is clear to everyone.